Hi, I'm Radhika Palkar, a practicing chartered accountant mainly working as an advisor to foreign companies with regards to managing their operations in India. I also take keen interest in associating myself with startups from the stage of incorporation, bookkeeping to income tax filing and in advising their management in cost price analysis. Thus, we act like a virtual CFO for the entities in their growth phase. I'm here today as a part of the tax video series by Canara HSBC Life Insurance Company. In this video, let's understand in detail the income tax calculation applicable for the financial year 2021. Total income from 5 different sources of income, less tax exemptions under each of the sources of income, if any. These tax exemptions are not available under the new tax regime. Less standard deduction in case of salaried individuals. Even this is not available in the new tax regime. Now, what you get is gross taxable income. From that, you reduce the tax deductions under section 80C to 80U, which cannot exceed the total above. Even these deductions are not available under the new tax regime. What remains now is the net taxable income. Divide this net taxable income into the following. Income subject to special tax rates. For example, short-term capital gains are taxable at the rate of 15% as per section 111A. Winnings from lotteries, crossword puzzles or racehorse or card games or any other game of any sort or from gambling or betting of any form or nature is taxable at the rate of 30% as per section 115BB. Now, the remaining income is subject to normal tax rates. Find out the income tax on the net income. Tax on income specified in 7.1 is at the applicable rates. Tax on the remaining income would be at the normal rates. From this, reduce the rebate under section 87A applicable in case of resident individuals having net income not exceeding rupees 5 lakhs. What you get now is the income tax after rebate under section 87A. On this, add the applicable surcharge of tax as calculated above. To the tax calculated at point 10, add the applicable surcharge. Surcharge is applicable as a percentage of the income tax. 10% of the income tax where the total income exceeds 50 lakhs, 15% of the income tax where the total income exceeds 1 crore, 25% of the income tax where the total income exceeds 2 crore, 37% of the income tax where the total income exceeds rupees 5 crore. Enhanced surcharge rate of 25% or 37% is not applicable in case of certain specified incomes, that is, short-term capital gain under section 111A, long-term capital gain under section 112A, and short-term capital gain or long-term capital gain under section 115AD1B. Now, find the total of 10 and 11. To this, add health and education cess at 4%. Find out total of 12 and 13. From this, reduce rebate under section 89, 90, 90A or 91, which is relief for doubly taxed income under section 90, 90A or 91. Now you get tax liability, which would be 14 minus 15. To this, add interest or penalty if any. For example, interest under section 234P for default in the payment of advance tax. From this, reduce prepaid taxes, that is advance tax, self-assessment tax, TDS, TCS. Now what you get is tax payable by adding points 16 and 17 and then reducing 18 from it. Hope with this video you now have a fair understanding of how to compute the income tax liability for the current financial year. Thank you.